Hello everyone, and welcome back to another ETF review. So I recently ranked VDY, Vanguard's FTSE Canadian. Oh, here, I should go down inside the corner just to make this a little bit easier to see. I recently ranked Vanguard's FTSE Canadian High Dividend Yield Index tied for the best dividend fund in Canada. Now, I did this for a variety of different reasons, and after a very deep dive of different Canadian funds, I looked at 16 different ones of them and did an in-depth, deep due diligence of my own onto them. This comes out on top along with one other, which I actually do recommend and invest in myself. And we're going to go through it today, as this is a fantastic fund and I just want to talk about it. So, the Vanguard FTSE Canadian High Dividend Yield Index. So currently a little over 4.5% of a yield, and we see it pays a monthly distribution. Now this fund is massive with over 2.37 billion assets under management, and rightly so. I think this one has performed excellently over the past, throughout its entire runtime. We're going to take a look at some of its returns. But its overview. Okay, so the Vanguard FTSE Canadian High Dividend Yield Index seeks to track, to the extent reasonably possible and before fees and expenses, the performance of a broad Canadian equity index that measures the investment return of common stocks of Canadian companies that are characterized by high dividend yield. Currently, this Vanguard ETF seeks to track the FTSE Canada High Dividend Yield Index, or any successor thereto. It invests primarily in common stocks of Canadian companies that pay dividends. So, the fund highlights. Let's go through. We're going to take a little bit of a look at the methodology that FTSE uses to actually select their stocks in a bit. In fact, let's do that now. So, I have pulled up right here, if we can zoom in on it. This is the FTSE Canada High Dividend Yield Index. It's directly from their fact sheet. So let's take a look at how they select the stocks that go into it, because Vanguard is just tracking this index after all. It is the index which is the most important selection of stocks for the fund. So how do they do it? Well, I think we can skip the very first paragraph there, because that just talks about the entire FTSE guys. Essentially, they're just talking about their entire total index. But FTSE Russell takes a starting universe of large, mid, and small cap stocks within the Canadian component of the FTSE guys. So FTSE guys just means there are all common stocks. You're not going to have any preferred shares. You're not going to have any income funds or trusts or anything like that. It's just the common stocks of Canada. So we're going to look at all of them, large, mid, and small cap stocks, and rank them according to their annual forecasted dividend yields. So how much are they going to pay in the future? Stocks are then selected based on yield until their combined market cap accounts for 50% of the total market cap of the universe of stocks. So we want to get half of the best pay of the market cap. So of all of the market capitalization of dividend paying equities, of dividend paying stocks, we want the half of them. And we want the best half of them, the highest paying half of them. So these stocks are then market cap weighted to form the ending index. So we're going to select stocks that pay dividends from large, mid, and small cap companies. We're going to rank these by what their annual forecasted dividend yield is going to be. Then we're going to select stocks until we have 50% of all of the market cap. So we only want half of the dividend payers. And once we have this list, we're going to weight this list according to the individual stock's market cap. So this is going to give us a very strong approximation of where those stocks are and in size of their impact on the economy and their impact on the Canadian market as a whole, and so probably a judge of their strength. So we're going to be a lot more we can expect to see a lot more large caps, some in Canada's case, maybe some mid caps, not too many small caps at all, actually. And final paragraph, the FTSE Canada High Dividend Yield Index will be reviewed annually. The annual review will be implemented in line with the FTSE Guys North American Index and rebalanced quarterly. Perfect. So they'll review it every year and they'll rebalance every quarter. So we're not going to see too much of the changing around of the market or of the index too much. They basically want to leave things as they are without too much trading. And as we can see, just from a 5-year total performance, if the FTSE Canada High Dividend Yield Index has outperformed the FTSE Canada All Cap. Canada has a lot of stocks, very strong stocks that are dividend payers, so it makes sense that it would be constantly weighted. And yeah, over a 5, not over 3, but yeah, consistent outperformance, by a little bit. Actually not bad. Yeah, 1% in a 5-year and over 4% in a 3-year return. That's that becomes consistently improvement. Didn't do better. 2023 was a bit of a weird year, but yeah. The stock has done quite well for itself. So basically, what we can expect from this is the returns of the dividend-paying companies, well market cap weighted. Perfect. All right, done with this. So what's actually inside the index? Let's continue on down with it. And taking a look at its performance, we can see that on a 10-year, it's done 7.8%. Very solid returns, 9% since inception. To over 12%, and on a 5-year, 13.9 on a 3-year, and 8.4 on a 1-year. So this has done quite well for itself and has consistently performed well. Growth of 10K, awesome. So drop in $10,000 5 years ago. This would be with dividends reinvested on, of course. You would see you'd have 16K, a little over 6K now. Solid. I like that Canadian funds often do this, a return of 10,000. It's a very easy way of visualizing the increase of your money. And not a lot of other countries or markets seem to do that. Risk and volatility, and we can see, yep, we're not going to have too much jumping out at us there. Perfect. So, portfolio characteristics. Currently, it's holding 52 different stocks with a median market cap of over 78 billion. So that's going to be a lot of large caps inside of there. And yeah, as we see the actual market cap weighted, large is going to be 91%, with medium being 4.6 and small being 2%. So we are heavily weighted to large cap stocks. Very, very stable. Completely North America, of course. This is Canada focused. Weighted exposure. All right, let's get into it. Financials, starting at the very top. Look at that. 56.36% of this fund is just into financials. Right after that, we see energy, which is 27.45%. So we're looking at over 80% of the fund right there is just into financials and energy, which makes sense if we're looking at large caps of the Canadian economy. Canada has some very strict regulations in terms of banking policy. Ergo, a lot of banks and life companies have done quite well, and their outreach to the broader aspects of the world. So it makes sense that if we are market cap weighting, that financials are so heavily. And then energy. Canada is well known for its pipelines and for its energy distributions and what have you. Now, its management of these companies come and go. We'll take a look at the actual holdings itself, but if we are looking at a Canadian fund stock, it makes sense that there's so much heavily into energy. Telecommunications, so there's probably going to be BL Canada and TELUS inside of there. There's really an oligopoly on 3 major telecommunication companies, and yes, they're dividend payers. Utilities are generally good dividend payers as well, and so getting into them when utility or that sector of the market is low can be a good option for dividend payers. And the rest we see just consumer discretionary, basic, and industrials. Not really anything else inside of there. Let's go down and take a little bit of a look. Okay, top 10 holdings, and right at the top of the list we can see Royal Bank of Canada, Toronto Dominion, and Enbridge. No surprise there. Some of the biggest companies in Canada, and they are well represented inside of the index. Bank of Montreal in 4th place right after that, 3rd bank on the list, and yet they're another massive one as well. They have a lot of industrial, so I should say Royal Bank of Canada has massive reach in Canada. Toronto Dominion is both of these are good investments on their own. Toronto Dominion has a lot of American outreach as well. Enbridge is a very, very stable company. It's a pipeline, so they're not a producer of energy or of crude. Really, they are going to be affected by that. However, because they're a pipeline, they're more of a midstream, and they are a necessary component of the Canadian economy. Bank of Montreal, perfect. These guys are a very solid running bank as well. Canadian Natural Resource, there we go, for our oil and crude producers down there. And then we see Bank of Nova Scotia. I think that's one of the oldest banks in Canada. I know they've been paying their own dividends for over 100 years at this point, and followed by CIBC. Now, I did mention that banks were very, very popular, and we see 1, 2, 3, 4, 5 of the 6 major banks well represented inside of the top 10 holdings. The 6th one would be National Bank. That's often included inside indexes as well, and is a solid institution as well as investment. I'm sure that if we were to export the holdings, we'd find it down there as well. And with Suncor is integrated oil and gas, so they own Petro-Canada as well as a couple oil fields, and so they're pretty solid. Now, they did cut their dividend in the 2020 excitement. However, that's one of the benefits of, and one of the reasons why you're very better off holding an index, because when excitement does happen, then there's no longer, if you are relying on those dividends for income, then a cut would not be nearly as bad inside of a fund. It wouldn't really affect the index. And as we're going to see, this fund does pay irregularly. It does pay monthly, but it is irregular. So not good for budgeting, or not the best for budgeting at least. Pipelines next. So TC Energy, basically the same thing as Enbridge. Copy paste everything I said there. And Manulife. Finally, we have a financial outside of a bank, and they are a life insurance company. Them and Sun Life are, again, very, very large and very, very oligopolist. We have the actual price return. We'll get into that. It's better to see it on a graph, I find. But the distribution history, this is what I wanted to talk about. So this is why I say the fund is not great for budgeting. It's great for total returns. It's not great if you need regular steady income that you can budget off of, because paid out, 19 cents last month, 16 cents. This is a capital gains distribution. So basically, if you were to ever sell this ETF, your capital gains tax would be a little bit less. So that's why it says 0 for the actual distribution. But back up. 19.4 cents, 16.7 cents, 16.2 cents, 15.2 cents, 17.7 cents, 17.9 cents. Highly, highly irregular. They're just paying out the dividends from the underlying holdings, and ergo, it's perfect for total return. All right. Annual distributions, not too much there. Beautiful. Now finally, we just want to take a look at the expenses. Always go to the ETF fact sheet to take a look at the expenses, at the expense ratio, because this is where it'll tell you the total expenses of the fund. So management expense ratio is 22 basis points. There is no trading expense ratio, so we're looking at a total of 22 basis points there. Perfect. That's not often the case. Many other investment companies actually will will publicly show their management expense ratio, but hide their trading expense ratio inside the ETF fact sheet. And just taking a look at the year-by-year returns, we can see a lot of positives there. And even in 2022, which was a down year, and 2020, which were both down years, not as bad of a crash as one could expect. It's done solidly. All right, now finally, let's get to returns and let's see how it's actually performed. So I've put VDY up against some of the other funds that I would, best funds in Canada that I would actually compare it against. So here we see VDY, and I'm comparing this against XIU and XIC. So XIU is going to be the S&P TSX 60 index, and XIC is going to be the total market index. After that, I also want to compare it against XEI. XEI is a competitor and a very popular one on a lot of forums and message boards. People like it. It has a very strong diversification, whereas VDY has a little bit more concentration. Now, XEI is better as a budgeting tool itself, but I'd like to just show its returns over the same time period and to explain why I put VDY at the top. Now, at the bottom here, I have two down here, which is XDiv. It didn't start until 2017, so that's why it's so low down there. And we'll take its better comparison, but I want to still have it on the graph as well. And then ZWC. This is a covered call fund, which is right across the from high dividend covered call fund from the Bank of Montreal. Now, this didn't start until 2017. I just want to show how covered calls really can kill your returns if you do not need that income today. Now, it is a good investment if you need that income today. They can work quite well for you. However, as well as a budgeting tool, they're very good as a budgeting tool. However, if you need, if you just want to let something drip and let something go, covered call funds would not be for you, and they certainly would not be for anyone in the early part of their investing career. So here we have the going all the way back to the inception date of this fund. So had you invested on the day that it opened, we can see that VDY would be the winner out of all of them. So XIU, XIC, and XEI both have inception dates before VDY. So we can see that, just on this very specific timeline, that it's done quite well for itself. Now it's November. Let's kick this up to January 1st of 2013. So had you dropped in some money in the new year, how would you have done? And again, well, we see overperformance from VDY. It's done quite well. Let's take the same thing in January 2014. How we looking here? And here we see XIU beats it out slightly, but VDY is still coming in at the top and has beaten out the total stock market index. Impressive, really. XIU is a very long-running fund. It's been around for since 1998, and I believe it is the oldest ETF in the world. Still a buy. It's still a great investment, by the way. Looking at moving it up 1 year into 2015, again, VDY showing outperformance. We're going to continuing to ignore XDiv and ZWC. January 1st, 2016. Boom, VDY coming in again at the top. Excellent. Now, I have I don't think XDiv started until August of this year, so we still can't quite look at the returns, but even so, VDY very close to the top, XIU coming in very close to the top, and XDIV, even though it hasn't started yet, just off this time period, I don't think it starts for another 6 months or so, it solidly beats out XEI. Interesting. All right, finally, we're up to 2018. We're able to look at all of the funds in return to each other now. So we see XIU and XDIV have come out on top. XIC and VDY have been tied during this time. There's a difference of what? 20 basis points, not even. So very, very solid returns off of both of these funds. Now, it just depends on how you want your returns. Do you need dividends being paid out to you every month, or do you not need these dividends being paid out to you every month? If you don't need them, well, XIC might have done a little bit better during that time, but VDY is still exceedingly solid. I should mention that XIC has a very low expense ratio as well. I think it's only 6 basis points, 7 basis points, so it is about a third of what VDY has been doing, and it has outperformed over this time. Again, we see XIU coming in very close to the top, and look at that XDIV, a fund that I like quite a bit, has pulled ahead. Now we are looking at ZWC, that covered call fund for Canada's high dividend stocks, and it is massively underperformance. We see XEI being at 55%, ZWC only having a return of 30.9%. Plus, you would have had to pay more capital or income tax off of your investment as well. All right, let's move up to 2019. Perfect. And from that, we see VDY again has pulled ahead. It's done XDIV, another dividend fund that I recommend, in second place, but XIU, XIC behind it, XEI trailing behind as well, and ZWC not doing so great. Let's take this to a 5-year timeline, and here we see a lot of almost everything doing the same. We see XDIV and VDY on top though, XIU and XIC very close behind it, XEI at the bottom of the list, and ZWC, that covered call fund, trailing behind solidly. All right, January of 2020. Now we know what's going to happen this year, but they don't know what's going to happen this year. Let's see how they perform. This is kind of how the economy reset and how we are in a different investing environment. How have things performed since then? Well, VDY takes top spot again. So it's done well over this time period. It is an excellent investment vehicle. XIU is in second place with the S&P TSX 60, followed by the total market index. XDIV and XEI, again, last place in terms of returns. So it is a very popular fund as well. VDY is superior and has had better returns and is what I recommend as an investment vehicle. And then ZWC, well behind. There's always a big gap between that one. Just for funsies, let's kick this up to March 1st, and boom, basically the same thing. All right, so let's take a look after the crash, starting in April 1st. April Fool's Day. How have things done since then? And here we see VDY coming out on top again. However, XEI has done quite well as well. It's in second place. This is the first time that we've seen it in second place. So, hey, in terms of the new trading economy that I just talked about, hey, it's done quite well. However, we also see XDIV coming up close behind it, XIC, XIU behind it, and ZWC bottom of the list again. Now, there were massive capital gains as money flooded back into the stock market this year, or in 2020, and in 2021, as there was a lot of money floating around inside the system. Let's see how that's affected things. And here we go, and back to seeing some regular patterns. We see VDY and XDIV on top, XEI coming in for a third place. Happy to see it in the middle of the pack for its investors. However, it has not it hasn't outperformed. It has solidly and consistently underperformed these two funds. ZWC finally not being as embarrassing. I don't mean that. It is good for people who need dividends every month and who are looking for that budgeting. It is simply just not best for total returns. But XIU and XIC kind of down there as well. Now, 2022, this year, things began to stabilize a little bit more back to normal. And we see XDiv coming out way on top. That's a quality dividend index, and that was the solid winner over the short time period, followed by XIC, VDY, and XIU in close place behind, and then XEI again, and ZWC hasn't won anything this far. Now let's take finally up to 2023 return since then, and including the rest of this year, and we can see XDiv, XFC, XIU have come out on top, with VDY being in the middle of the pack. So it actually didn't perform quite as well over the past 1 year, but it did outperform XEI, and it did pay out those dividends every month. So I do recommend a good split between VDY and XDiv for dividend investors looking for solid funds. And then ZWC, again, falling last place, and just taking a look at those 1 year returns. We can accept, basically the same thing. Finally, off of this one specific 1 year, so that would be end of January 2023 to beginning of January end of January 2024, we can see that ZWC finally comes in ahead of something, and it comes in ahead of XEI. Very, very curious. Now, 2023 was a weird year. You could have done well if you were investing in the right stocks, as shown by VDY and XDiv, and even by XIU and XIC. However, if you are looking to, I would still invest in XIC. I don't like covered call funds nearly as much as their popularity belies. I think that they can be well used in certain situations. However, for passive investors, they do not perform nearly as well. Now, if you can get in at a good price, I mean, they are excellent dividend payers, and if they're an excellent budgeting tool. However, they are not good to drip every month. Now, finally, so now that we've looked at the returns, we've seen VDY and XDiv really are our best winners out there. VDY has consistently outperformed over a 10-year time period, and looking into the future, I would expect it to perform extremely well as well. Plus, a 4.6% dividend is nothing to laugh at, even if you just wanted to spend your dividends every month and have that as income. It's a solid option. It is a very, very solid option. And finally, I always do this. I can't help myself, but I like to look at the Yahoo Finance. And I always take a look at the conversations just to see if anybody's talking about anything here. So sorting by top comments, somebody asking, can anybody explain this? It's about a capital gains distribution. So yeah, essentially what this just means is there is a dividend paid out generally every year that you get $0 for. You don't get any money for it. It is not paid out to you in cash. Instead, it changes what the price of the fund is. So if you were to ever sell this inside of a non-registered account, you would have to pay less capital gains tax. It is a good thing. Just because you're not getting money for it, it is a very good thing. Tommy says, buying for long-term dividend income and reinvest over and over repeatedly. Solid strategy, my man. Man, does this thing just keep growing its dividend over time? I've only owned it for half a year, and it feels like every month it just grows and grows its monthly payout. I agree, Nucleus. I wouldn't say monthly, but I would say yearly. Planning to put 20% of my portfolio into VDY at price of 38. Good, excellent price, Legit. If you got in at 38, and it's well over 42.5 right now. Something about a misprint, whatever. Happy dividend day. I love dividend investors. You guys are chill. It is a very, very easy way to explain this returns of the stock market to beginner investors, and it is a very good starting point. Just bought 51 shares at 39.71. That's a fantastic price, my friend. Remember when we used to make money? When maybe one day we'll get a business-friendly prime minister again. Okay. Nobody makes money. All we do is bore it. Worst leader in the world, not experienced. Okay, take your politics out of here. We're not going to criticize our prime minister. We are merely going to act as investors, and we are going to deploy our capital as best as we possibly can in relation to geopolitical events. We're not going to complain about things. What we're going to do is we're going to invest around them, and we're going to trade, buy quality assets at reasonable prices, depending on what this political situation is going to do. We can always work around that. Complaining about it is not going to do anything. Oh, one day we'll be able to tell our grandchildren how we all were alive when stocks actually went up on occasion. The good old days. I'm quite sure what you're on about, Terra 3. On occasion, you mean for 10 plus years? Yeah, the market corrections are needed. A very new investor there. It is an excellent time to acquire more. Started a small position this finally. Good for you. Yes, start a small position in it. Whole energy and bank sector is getting hammered. Buying this will accumulate until rates are brought down instead of picking single stocks. Very, very, very good use of this fund. All right. So as we can see, sentiment is relatively positive. This is a fantastic fund if you want to just buy and hold for a long term and be a dividend investor who does not need to worry about the vicissitudes of the market. So yeah, I strongly put this as tied for my #1 spot. If you are a dividend investor who is a more passive, hands-off investor who is just looking to get the returns of the Canadian economy being paid out to you on a monthly dividend basis, or eligible dividend basis, I should say, this is a fantastic way to do it. Thanks for tuning in. Now, remember, if you are an investor, if you are putting your money away every month, if you are watching videos like this, you are so massively ahead of the competition. It's not even funny. It's I know sometimes it can be difficult not talking to anybody about this, particularly when you are out crushing it and doing very well at life when your contemporaries are not. However, know that you are far, far, far ahead of them. Keep investing, and if you are looking for a dividend fund, pick up this one or XDIV. And if you can't decide between, I'm going to do a video on XDIV as well. If you can't decide between the two, just split your money between the two of them. Enjoy the dividends coming in at 2 different times every month, and keep investing. You are doing a fantastic job, and I'll catch you next time. Peace.